What does the Fed's latest decision mean for fixed income? Hi, I'm Chris Alwine. Today we're diving into the implications of the Fed's recent meeting and what it could mean for the bond markets. The decision at July's Fed meeting was as expected. It was an affirmation of what the market expected. The market was not expecting a cut. The Fed reiterated the drivers of their decision making. And it's ultimately, they look at an economy that's close to trend, but slowing, an inflation rate that is elevated, a tariff policy or the implications of that policy quite uncertain, the Fed funds rate that is viewed to be modestly restrictive. And that was a reiteration of past meetings. But the nice thing with this meeting is it allows 2 months of data to come in. And at that point in time, there should be greater clarity on the path of growth and inflation. Now, when the Fed thinks about this, we think they're a little bit leaning towards the growth side. The chair of the Fed did discuss that the labor market has come into balance from a reduction in demand and supply, and that leaves further vulnerabilities of a weakening labor market in the future. So at the margin, we believe that they are leaning a bit toward cutting, but the inflation rate and policy uncertainty on the tariffs leaves them in a wait-and-see mode. Now, when I think about the implications of this in the short term, it's a bit of an unwind. The market began to price in a higher likelihood of Fed cuts between now and the end of the year. Some of that has been priced out today. We saw the yield curve bear flatten. Well, it does matter for the level and the slope of the yield curve. Now, what the market has been doing for some period of time, and it is reflected in a range-bound 10-year Treasury market, generally between 4 to maybe 4 3/4. So 10-year Treasury rates are the average of all the short rates plus a risk premium. And so when the short rate changes, does matter, especially on the front end of the curve. But what the market has done is it just pushes out. It's at the margin in terms of policy paths or the path of short rates it takes place. Market believes 3 1/4 to 3 1/2 is the neutral rate. That's neither stimulative or restrictive in policy. With the Fed funds at 4 1/4 to 4 1/2, that allows for 50 to 100 basis points of cuts. And so the market expects that, they just don't know when it'll start. And if it doesn't start in September, then it gets pushed back to December. Well, these aren't big changes. A big change would be if the market began to believe that the Fed wasn't going to cut and was going to hike, or they had to cut a lot more than expected. But we've been in a world now for 6 months or so that anywhere from 3 to 6 cuts have been priced in, and they've just been moved out or in based on short-term data flow. What will drive when the cut takes place is the data. The Fed is highly data dependent. So Fed policy certainly has an impact on corporate bonds. So credit instruments are sensitive. Typically, when the Fed is cutting rates, that's supportive of corporate bonds outperforming. Now, what we've seen this year is significant tightening, credit spreads or corporate bond spreads. So we feel that they are actually fully valued, but we are not looking for any type of meaningfully underperformance or widening of corporate bond spreads. And the reason for that is the fundamentals are strong. If we look at the corporate health, it's in very good shape. But we also look at technicals. The technical amount of the supply of the bonds in the market versus the demand is also healthy. So at the margin in the short run, this might slow down or possibly stop the tightening that we've seen as the Fed has maybe at the margin disappointed the market in terms of the timing of the rate cuts, but it still leaves us in an economy that is growing, the Fed that is biased to ease on any type of weakness, where technicals are strong as well as strong fundamentals. So we're not expecting any meaningful change in corporate valuations. What could change that is certainly the direction of the economy. As I talked about, the data dependency is so key here. What happens to growth? What happens to inflation? The challenge today is that the policy of the tariff policy is still working its way. Those impacts of that is still working their way through the economy. And so the market's looking at that, we're looking at that, the Fed is looking at that. Our expectation is we're going to see slower growth in the second half of the year. That comes from higher inflation, which reduces real wages or real income, and that should slow down growth. That leaves a small upward pressure on the unemployment rate. So slower growth, but inflation still around 3%, puts the Fed in a little bit of a challenging position. Inflation's still higher than they like, but growth's a little bit lower than they like. We think that they're likely to ease in that situation, and that should support the economy, should support corporate bonds, and then sets us up for possibly an interesting 2026. Fed rate setting certainly has an influence on the yield curve, level as well as slope. The front end in particular, the front end is really driven by the expectation and then the follow through of where the Fed is setting the policy rate. Out the curve has more impact from inflation expectations, long run policy rates. When we think about where 10 years should trade, where's fair value? We think they're right around fair value today. So think of that between 4 and 4.75%. So that's a world where Fed has policy roughly unchanged. So policy around here, maybe a cut or two. Inflation trends around now or goes up or down a little bit, possibly 2.5% or so. But that's fair value. That's our base case. So our base case is a bit more of the same, but then the risk to the downside. So the lower rate scenario where we get a steeper yield curve is the slowdown. So our view is that the economy is likely to slow down. That puts some downward pressure in rates and steepening pressure on the yield curve as we expect the Fed to cut possibly up to 3 times. Now, the calendar is working against that view, given that there's only 3 more Fed meetings in 2025, but we would expect to see the Fed cut up to 2 times in the remainder of the year in that scenario. So we think about our fund strategy, trading tactically in the range, but we have an eye towards a potential rally because the risk from the tariff policy is more shorter term in terms of how does that affect growth when tariffs hit. Now, our belief is that tariffs aren't going to hit all at once. They're going to be spread out over 2 to 3 quarters. And so that uncertainty may last a bit longer simply because the impacts are going to be spread out over a longer period of time. The big question is, what does that mean for 2026? So we are going to see more deregulation. We are seeing a tax bill which has some level of stimulation, and we're seeing higher levels of investment taking place in the U.S. economy. When we listen to company management, they have more investment plans they've had in the past 6 to 9 months. So are we going to be setting ourselves up for a world that's potentially stronger growth in 2026, supported by Fed cuts in 2025 to address the near-term slowdown? That's a little bit beyond our investment horizon, but it's something that we are keeping an eye on to think about how does the economy move from the near term to more of a cyclical view, which would be 6 to 12 months. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.